So if you've been watching my videos and you've been understanding my investment style, you know that I think the economic mode of a company is very important. I mean, you can read a little about what an economic mode is, and basically, it's competition and how you protect yourself against that competition. So, what I wanted to look at today was how we can tell from the financial metrics that we have whether a company has competition, and in particular, whether it has very little competition. So, I think one of the best ways to look at that is through a financial metric called the operating margin. So, on the screen, I have the operating margin of a few companies. These are the companies I found that I mean, at least some of them I know have very high operating margins, and I also added in a few luxury brands. So we have Visa, we have Master, we have MSCI, we have SP Global. Ferrari was a luxury brand I thought of, and then we have Louis Vuitton, we have Apple, we have Moody's as well, and then these are the two benchmark indexes. So on the screen you can see that some of these companies have extraordinary operating margins. You can see Visa, Master, MSCI, SP Global, and Moody's have very, very high operating margins. And in the comments, if you can find companies with higher operating margins than this, please let me know, because I'm interested to know. Some of the luxury brands, they don't really have that high of an operating margin. I thought it would be higher, but when I looked it up, it didn't seem that high. So I guess there's a distinction between offering a service like these companies do and offering a luxury product that these companies do. Because eventually, if you're making a product, I mean, there are going to be operating costs involved. And I think that's one way to look at operating margin. So basically, an operating margin tells you how much operating cost there is in the company, whether there's high capex, whether there are high operational costs, there are high marketing costs or high other software costs or stuff like that. And it also tells us whether there's competition, because basically if you have high operating margin, that gives you a lot of pricing power, and you're able to charge what you want to charge, and you don't have to undercut your prices because basically there's no competition to undercut your prices. So let's look at the operating margin over a 3-year median, and I usually look at that for a more smoother graph, which evens out some of the downs and ups of certain years. So, but then again, we still see a very similar picture. Visa has an amazing operating margin of 64, Mastercard not far behind, 54. The three companies, Moody's, SP Global, and MSCI, they overlap in terms of some of their business, which is in terms of providing credit ratings. MSCI is not in the credit rating, but SP Global and Moody's and another company called Fitch are in the credit ratings business. MSCI overlaps with SP Global in the index business. So you can see that when you don't have that many competitors, basically, and MSCI only has SP Global basically as it's one of its main competitors. There's also the London Stock Exchange, which has the Russell Index, but that's not as popular as some of the indexes that MSCI and SP Global provide. And then you can see Moody's as well. It has very high operating margin, and it only has SP Global and Fitch as a triopoly, basically, in the credit ratings business. And you can also tell that they don't have much operational costs, because basically what they're depending on more is human intelligence, human capital, and that is what powers their business. So ultimately, what we want to look at is the share price growth. So let's take a look at that, and let's take a look at how these companies did against the benchmark indices. So you can see the MSCI World Index is right here. The S&P Y 500 Index is here, and you can see all these other companies have beaten the index hands down. So it tells us that if you are in a duopoly or a triopoly, basically that is a very good sign that your business is going to do well and it's going to probably beat the market. So I think the word duopoly really whets my appetite when I find a company that is in duopoly, and that's a reason why I'm interested in Boeing and Airbus. They're also in a duopoly, but they're in a different industry where operating margins are not that high because they have to prioritize a lot of other costs, like perhaps safety, because they make passenger planes. But I think if you find companies that are in duopolies or even a triopoly, I think that is a good recipe for finding a good company that will eventually beat the market. Let's look in a bit more detail at MSCI and what it does. I'm gonna actually just let MSCI do the talking here, and if you want to skip ahead, you can skip ahead a minute and half to the end of this part. But let's see what MSCI does.
Making a better investment decision. To us, it's a science. When you see what our DNA of relentless innovation has done at MSCI, you never look back. Instead, you create forward, building models and indexes that lead the financial industry. An open architecture platform that seamlessly integrates with client data, systems, and workflow. ESG research and indexing, adapted for each client. Factor investing, to create clarity from confusion by overlaying existing strategies. Even backtesting for more certainty, for actionable solutions to fit your unique needs. At MSCI, we innovate as naturally as we breathe or blink, because our conviction is that a better decision doesn't come off a shelf. A better decision is powered by the drive to deliver our clients every advantage, and by a culture of invention, powered by the belief that
Oops, it seems like the video is buffering.
today, ROI also means return on community, sustainability, and the future we share. Whether it's a pension fund we guide through a storm, emerging markets where a better tomorrow hinges on capital investment, companies who no longer see diversity as a token gesture but a top-down mission. The decisions we help our clients make understand the effect they have in the world, because increasingly, what the science of investing reveals is that powerful decisions actually create a better world. MSCI.
So, in a nutshell, that's what MSCI does. I think one of their flagship products is really the MSCI World Index, which I showed earlier in the graph as well. So this basically is the index of some of the major companies around the world, and you can see that it includes companies from all these countries here. I think this is the index that a lot of active managers actually benchmark their performance against. And you can see actually the MSCI has done pretty well. These are some other flagship indexes that they have. You can see that the MSCI World Index has about 1,600 companies within it. So I think we got an idea of what MSCI does. And I think the other thing that's really been useful for MSCI is the move towards passive investing and index investing. And we know that index funds have outperformed the majority of active managers, and that's why more people are moving towards some of these passive index funds. And so all these index funds, like perhaps BlackRock, they will actually have to license index basically from a company like MSCI, and that's really been a boon for a company like MSCI in this time. And SP Global as well, I mean, they are behind the famous S&P 500 index, right? So they're also benefiting a lot from this mega trend. I would even call it a mega trend because so much money is flowing into passive index investing. And speaking about S&P Global, so this is a little information about S&P Global. They are a leading provider of transparent and independent ratings. That's one of their business. They also provide benchmarks. That's the index, and analytics and data, market data basically, from all the companies that they review. So you can see here, these are the divisions: the credit ratings division, I think these two are the market data divisions, and this is the index division. So I think when you're choosing companies, try to find companies with very high operating margins. There are exceptions to the rules, like I mentioned Boeing and Airbus, right? But they are in a duopoly, so they don't have much competition either. And then there are companies like Amazon, which have very low operating margins, but that's a different story because Amazon is investing very heavily, in its business, and it also has a very long runway in terms of the secular trend that is following in terms of e-commerce, in terms of cloud computing, and in terms of digital advertising. So there are exceptions to the rules, but in general, if you find a company with a very high operating margin, that means a lot of their revenue can just really drop down to that bottom line. And eventually, as an investor, that's what you want. You want your company to earn massive profits. So I hope you enjoyed this video, and leave a like and subscribe if you haven't, and please share this video as well. And drop your comments. Let me know if you know of other companies with very high operating margins. And I look forward to seeing you in the next video. Thank you.